And global financial markets and Bitcoin are now more correlated to tech stocks than in the past, according to Chainalysis. Nevertheless, there's one important difference between crypto and traditional finance, and that's transparency. Joining me now to discuss is Kimberly Grauer. She's the Director of Research at Chainalysis. Hi, Kimberly. Thank you so much for joining us. So I want to highlight an article that you wrote. It was how the crypto industry can leverage blockchain's transparency to understand, prevent market contagion. You know, on this show, we often talk about Bitcoin price, but your report makes it really clear that we have to understand centralized entities as well as DeFi to really understand the markets. And it's really relevant right now as we're seeing the contagion effects of UST, Celsius, Three Arrows Capital, Babel, which is why, you ask, why is Bitcoin's price crash more extreme than traditional stocks right now? So maybe we can start off there.
Well, one thing that the chart you just showed was showing the relationship between Bitcoin prices and tech stocks. And one kind of new, we've seen many crashes in crypto. For those of us who have been around a long time, we kind of like to sometimes count up the number of crashes that we've seen, what counts as a crash. There have been a lot. And I think what's different now is now crypto is increasingly correlated with the stock market, and this is a sign of maturity. The difference being, and so we're in a bear market across the board, and stock prices have been falling consistently, especially since the news of what was higher than expected inflation was released, I think, about a week and a half ago. And the swing in crypto was actually a little bit more extreme than what was felt in the stock market, in the sense that the price dipped more for a few reasons. One, the inflation news came in late on a Friday, and crypto markets are 24/7, so they're trading all weekend. They have more time to kind of react to that news. But also, increasingly, we're seeing that a lot of the declines that we've seen now have been kind of caused by some of the events related to the UST incident, which we highlighted, which was a stablecoin UST kind of getting depegged through a series of events targeting the liquidity pools, which we highlight in another blog. And that had a cascading effect because of the way UST was used as collateral in other projects, which destabilized other projects in addition to just what we saw with UST. So that kind of caused the swing to be a little bit more extreme. But a few days after that, things kind of restabilized, and we show how the correlations kind of matched the tech stocks again.
I guess to underline that, you mentioned that after the crash in crypto that we saw in 2018, DeFi experienced this explosive growth. So a lot of money was going to DeFi. We have a chart on how DeFi value went up compared to services. There we go. In orange, we see DeFi value going up, and yet, or rather going down towards the end, and services going up in navy. So what does that tell us?
This was a really interesting chart, and then the subsequent chart that we saw after this that helped put everything into perspective. So after the last kind of crash, when we started to recover, we saw an explosive growth in DeFi, peaking up through May of 2021 in terms of the total economic activity associated with DeFi platforms. But that kind of petered out. Actually, we saw you can't keep this, seismic exponential growth forever. So things kind of stabilized and they came down a little bit. But in spite of that decline in the total value associated with DeFi platforms and specifically lending, we saw an increase in the number of services, DeFi platforms, specifically lending platforms. So there's more competition fighting for fewer dollars. And because of that, it's almost incredible how you see this right when the DeFi really starts to kind of come down. We see lending platforms start to receive more of their money from other lending platforms that are generating more yield. And I think the takeaway from this is to promise high high returns for potential investors. Some of these platforms are promising, 5-10% returns on any investments,
We actually have the chart there on the lending contracts chart, and shows how lending platforms have to promise higher and higher yields to continue their growth. And so they're actually relying on other lending protocols, became, part of that equation.
Yeah, this chart really kind of put things into perspective for me. We see because with blockchain data, we're able to see, which is, you talked about transparency at the top of the call. We can see where funds are coming from, how investors are choosing to invest their customers' funds. And we can see that increase in funds coming from those other lending platforms. And we interpret that to mean that there's more services, there's more lending services. They're chasing fewer investment dollars. And so in order to promise returns that will attract those customers, they need to go and invest in riskier projects, and therefore kind of find yield in other places that are a little riskier.
Yeah, and in the last chart, it shows the inflows to DEXs and centralized entities as well during big bear events like the UST depegging, which was, as well as the higher than expected inflation there. And so it's just interesting, how the lending bubble just continued going on, and how that burst. And then we see what happened here with these inflows. What can you tell us about, what is the ultimate impact on Bitcoin, and what can you say about market contagion in general in the crypto markets?
Well, one thing that we started to think about when we were interpreting this data was that this is all happening in the stock market as well. Investors are panicking. People are pulling out of tech stocks as well. But we don't know a lot about the nature of who is invested in what and why, and how are people covering their lost positions, and how are people dealing with the fact that they might have massive liquidations. But the thing is, it's not really available for the public to be able to interpret and understand what exactly is happening behind closed doors with investors who are invested in tremendously in tech stocks. But that's not the case with cryptocurrency. And so I think that with this crash, we're able to see, where the funds are received from certain platforms. We're able to break down where investments might have been. We even have the ability to understand the number of liquidations that are happening through different contracts. We can see where people are invested, when they invested, and there's so much transparency around positions. Of course, this isn't the case with a more centralized controlled service that might invest in DeFi protocols, but does so off-chain. But still, there's the level of transparency means that we're really able to break down exactly what's happening. And that gives us hope that in the future, we will be able to, better understand these situations and prevent them from happening again.
That's really interesting. So you think that this is happening in traditional markets right now, but because there's a lack of transparency, we can see it also happening in crypto markets, but with the actual data in real time. So now we're seeing, Celsius, Three Arrows Capital, Babel, they've suspended customer assets, possible insolvency. We do not know that for sure yet. But can we predict what other centralized entities are at risk of insolvency right now?
I think that we can, if a transaction was made on the blockchain, then the fingerprint will be there. And we can see from that one chart that we showed before, that's not data that's coming from people who reported that from us. That's literally looking at the blockchain transfers to show where are funds coming from that are going to lending platforms. So you can get a sense of if there's a protocol, their lending protocol, we can see what their source of funds are. And the last point I'll kind of make on this transparency is I think that there's this kind of double-edged sword of the transparency of blockchain data, which is that because we're able to see all this, we're able to see all the liquidations happening. We have There's known kind of liquidation hunters because they guess they are able to see what the liquidation points of investors are, and they can kind of go after positions. The double-edged sword of this is that it puts so much attention on the kind of on what's happening with crypto markets because we can see this data. So, but the kind of the transparency is also kind of its saving grace. So we're talking about all this stuff happening, and we're able to see it with data, and that kind of sheds this light on what's happening, which kind of people then interpret negatively. Oh, there's so much risk and contagion in crypto markets, but really it's just the fact that we can see this using blockchain data.
Fascinating. So what kind of lessons can we interpret for this, and especially regulators who want to come up with some sort of framework for cryptocurrencies in the future? What kind of lessons can we learn from the data we have right now going forward and applying them to prevent, big market downturns like we're seeing right now?
I think right now the biggest thing is that we need to be able to understand systemic risk, and we need to be able to understand it through having this transparency and being able to tell regulators this is exactly what happened and we can see this happening. And I think that that's like a powerful next step for us to really hammer home. And then, obviously work with regulators and start with this foundational truth of this is what happened. This is how much risk there is. This is how connected these lending platforms are to each other. Let's build from here.